Welcome back to part 2 of the credit scoring tutorial chapters. Now, numbers suggest that many consumers distinguish the relationship between their credit score and their borrowing power. And awareness of your credit scores and the formula will empower you. And this is particularly important for hopeful real estate buyers. The more you understand what goes into credit scores, the more confident you can feel about the borrowing process and the less likely you are to become victims of the banking and insurance systems. Now, obviously, credit scores are particularly important to home buyers and other borrowers, but it should be of interest to all consumers. Even if you don't plan to borrow more money, you may find yourself in a situation where you need credit, perhaps to take advantage of an opportunity or to get through an emergency. And it's not just lenders who look at your credit history to make decisions anymore. Credit is being considered your life's financial report card and is reviewed by employers, insurers, and landlords when qualifying applicants. Knowing where you stand allows you to build an action plan to improve your credit worthiness. As we discussed during part 1 of the personal credit scoring chapters, consumers with good credit history and high credit scores can begin to access debt weapons, which provide many more options for accelerating financial goals and having the lifestyle of your choice. On a cold, snowy night in December of 2009, I was presenting to an audience of about 90 people, and they had made their way through the dangerous streets of Denver, Colorado to learn the same types of strategies that you are now learning. At the end of the class, I had several people approach with questions, and I took note of a tired-looking woman off to the side, standing and watching. As I was loading my car to leave, she approached me highly emotional. I remember thinking how frazzled she looked, but couldn't help admiring the hope and optimism that she expressed after hearing many of the secrets that I'm sharing with you here today. She told me that in the 3 years prior, she and her husband Dan had accumulated nearly $50,000 worth of auto loans and credit card debts. She explained that much of the debt was needed to start his business, but that they were beginning to feel that they would never dig their way out. That woman was Megan Albright, and I'm so blessed to have their permission to review the past few years of their story with you throughout the video series. You'll see exactly which steps they took to not only kill the $50,000 of debt, but also design a plan to rapidly buy and own real estate free and clear. Their first step to this brand new life was to complete their cash flow cruncher, which we explain in another tutorial chapter. In exchange for sharing your feedback, you will receive your very own copy of this cash flow cruncher spreadsheet at no charge. After they spent a few minutes filling that out, we asked them to provide their FICO credit scores. Now, while simultaneously helping them plug leaks in their cash flow cruncher each month, they went to myfico.com and pulled their 3 primary bureau FICO scores. Now, by focusing on 3 primary areas, one can almost always plug between $100 to $1,000 every single month in what we call leaks without sacrificing anything in lifestyle. Now, $100 a month in additional cash flow may not seem like a lot of money, but when that cash flow is used properly, it is worth 3 to 5 times its face value in prevented interest and opportunity worth. In Dan and Megan's case, we were initially able to identify just over $500 in leaks, improving their cash flow from $390 on average each month when we first met them to approximately $900 on average every month. It was an excellent start, but for them to take even bigger steps toward accessing debt weapons, it would be necessary to increase their personal credit scores. Here are a few things that we taught them. First, your credit score is simply a snapshot in time of how risky you appear to be at that particular moment. The snapshot changes as new information is either added to your bank and credit bureau files or removed. That's good news for consumers with less than perfect credit. So even if you have less than a 700 FICO score, which is the minimum needed to start getting access to these debt weapons, you can gradually improve your credit worthiness by handling credit differently now and in the future in order to generate a rapid impact. In general, the most commonly recommended ways to improve your creditworthiness are to pay bills on time, pay any delinquent accounts, and lower your total credit card debt to available ratios. Now, no matter how many credit cards you carry, it's a good idea to keep the ratios of outstanding balances to total available credits as low as possible. Credit scores look at how much of your available credit you've used. So this is known as your debt to available ratio or utilization ratio. When you close any account, it drops the available to the current limit. From a credit scoring perspective, rapid debt reduction should start with the accounts on which you are closest to your credit limit. Though from the point of view of shrinking the overall amount of your debt, it's best to watch the non-mortgage debt elimination tutorial to learn about the other factors to consider. Be aware that paying off a collection account or a judgment will not remove it from your credit report unless the creditor agrees to provide the credit bureau's proper documentation to have the account removed. If not, it's going to stay on your credit report for 7 years, and it can even hurt you more in the short term to pay it off. If you have circumstances such as these, please discuss these issues with an expert in your area or with your expert coach during your free coaching session that you'll receive as the second part of this training series. Now, research also shows that consumers with longer credit histories have a lower risk of default than people with shorter credit histories. However, even people who have not been using credit for a very long time might get high credit scores, depending on how the rest of the credit report looks. Depending on your overall circumstances, you may be able to even use strategies to add lengthy credit history to your accounts quickly. The current rules can be discussed during your free coaching session. This is another reason that it's recommended not to close any unused credit cards as your short-term strategy, because owing a fixed amount but having fewer open accounts may lower your scores. This is why I listen to some of these other experts that are teaching about credit scoring and simply shake my head. Yes, from a fiscally irresponsible standpoint, if you cannot control your spending habits, it's best to close your credit availability. However, if you think that you can be fiscally responsible and possibly it might require help, then it is to your detriment to close any accounts. Equally, opening a large number of new revolving accounts in a short period of time just to increase your available credit can backfire and actually lower your credit scores for the short term. Every time someone requests your credit report from a credit bureau, an inquiry is noted in your file. Too many inquiries on your credit report can signal looking for new credit, and it may lower your score. You should apply for credit only when you need it and wait for applying for more. FICO credit scores can usually identify rate shopping in the mortgage and auto lending environments so that you're not penalized with multiple hard inquiries related to one credit transaction. Now, to be safe, it's always a good idea to do your rate shopping for a given loan within a short period of time. Note that if you order your credit report from a credit reporting agency to check it for accuracy, it will not affect your credit score as it is not indicated that you are seeking new credit. Someone with no credit cards tends to be a higher risk than someone who has managed credit cards responsibly. Still, it's not necessary to have one of every type of account, and it's not a good idea to open credit accounts that you don't intend to use. You don't improve your credit worthiness by carrying balances forward from month to month, as opposed to paying each bill in full. But lenders might be more likely to offer credit to people who carry balances because they have a history of paying interest on their accounts. So there are some strategies that we will look at during your free coaching session. Now, I've saved a very special strategy for last. Creditors often report your balance on or around the statement closing date, which is the last day that transactions are counted and statements are closed and sent to you for payment. This is generally the period that your account has the highest balance for the month. Let's say, for example, that Dan and Megan have a $5,000 credit card, which they plan to use for their living expenses each month, and then pay off in full. And let's assume that their expenses each month total around $2,000. By the statement closing date, they've spent their $2,000 and the creditor reports that balance to the credit bureaus, which in turn represents a 40% utilization ratio. Now, knowing that Dan and Megan were in need of an increase to their credit scores as quickly as possible prior to accessing additional debt weapons, we recommended that they begin to pay on the account early, which resulted in a lower balance being reported each month. Coupled with additional suggestions, the Albrights earned a substantial credit score increase within approximately 2.5 to 3 months of first meeting VIP. Now, obviously, results vary, but getting started early is an important part to seeing results early as well. Now, here's how to get your credit scores. You can get all 3 FICO scores and credit reports at www.myfico.com. You can also try to get your scores by asking a lender who you've submitted a loan application with. Some will reveal it and some won't. But remember, when they pull your scores, it will count as a negative inquiry against you. If you pull your own and pay for them, it does not count against you negatively. Let's talk about correcting errors. Consumer organizations advise people to review their credit report every year or so, particularly before making a large purchase like a home or a car. Now, this makes it possible to correct any inaccuracies before applying for the credit and or to catch any fraudulent activity using your identity. If your score seems surprisingly low, check for inaccuracies in the credit report that generated the score. If you do find errors in your credit report, contact the credit reporting agencies directly. Thank you for tuning in to this 2-part series on personal credit scoring. We've just scratched the surface, and we're happy to go into your personal credit profile in order to determine how we can either maximize your scores or protect your high scores. We encourage you to watch all of our short video tutorial chapters within the 100% Debt-Free for Life training, and then schedule your free one-on-one coaching session with one of our experts to determine which techniques apply best to your circumstances. Now, after you see the other videos, also don't forget to get your free cash flow cruncher by pressing the button above and answering a few brief questions on the feedback form. And finally, if you appreciate the value of the education VIP is providing our community, please share a link to the website with your friends, family, clients, and coworkers. Remember, cash flow plus education equals power.